What is up, everybody? Welcome to the Monday Mortgage Market Update with myself, Sean Grapevine, Director of Agent Direct, coming at you live here from kind of smoky Smyrna, Georgia. And I am excited to be here, excited to launch an especially auspicious Monday Market Update. But before I get to its auspiciousness, I'd like to introduce my co-host who joins me almost every week. He is the Mac of the Rate Stack. He has bips for breakfast. He does best efforts with no efforts. On his golfing outings with Jerome Powell, he decides whether money printer go or not. He's the Colossus of credit, the king of collateralized debt, the Sultan of SLAs, the Lord of the Locks. His name is the awesome Austin Koenig. Welcome, Austin.
Sean, thanks for another great intro. Let's get into it. What's auspicious?
Oh, it's the end is nigh. You know, the soft landing is in. We beat inflation, and the battle of the last 15 months. It's over. Don't worry about it. It's done. CPI's at 3, core's higher, but who cares? I mean, like those numbers are so low they may as well be 2%.
That was a good print we had. Nonetheless, the market got excited about that one. So that was one of those things where we saw 10-year above 4 for a little bit, and then we got the thing to drive it down. And I think the kind of where rubber meets the road is, let's see if we can stay here in this sub 4 10-year range and keep to it. I think everyone is gearing up a little bit for the next meeting, which is not this week, it's next week. But for right now, I think everyone's still pricing in a hike, all things considered. 25 bips still going to come through in July. But I think the real meat here is, how did the Fed think about this CPI print, and what's the going forward strategy? Where are we going to end up? Is it going to be continued strategic pauses, going forward? And the CPI print was great. I mean, 3% headline, great. A lot of that was driven by energy, all things considered. But
great energy. I agree.
Great energy. Commodities are not commodities. It was great energy, and then we also have, with core getting better than it was expected, which was good. Nonetheless, it's all about the shelter stickiness there. Just services and shelter kind of staying sticky. But all things considered, we have a very healthy equity position in the housing market for most of the homeowners that currently own a home, especially the ones that purchased, right, the dawn of COVID or before. Like they have good equity. They really do. And at the end of the day, there's just still a supply issue when it comes down to housing. You guys face it every day. As purchase loan originators, it's there's competitiveness still in the housing market, regardless of what the Fed does.
Sure. I 100%. And my original excitement about the soft landing, it was a bit tongue in cheek, but it is something that seemed out of the question back in August and September of last year, right? Like runaway inflation. Inflation was at 9%, and the Fed had really just started their I had actually been engaged in a series of rate hikes for 4 or 5 months, and not seeing any movement on CPI, and everybody was talking about Paul Volcker, right, in the 80s, essentially driving the economy into a purposeful recession in order to stave off and choke out inflation. So everybody was just GDP is going to go down. There's going to be a recession, and we did see 2 consecutive quarters of negative GDP, which we didn't call a recession, but nonetheless, if there was a recession, then it was relatively light, and economists are now sort of reforming their thoughts about what the coming quarters will bring. They expect a contraction to the growth rate of GDP, but it doesn't sound like they actually expect a contraction of GDP below 0%. What are your thoughts about, like, is it too early to? It's probably too early to celebrate, unless you're me. But is it too early to start hoping with a bit of reasonable reasonable hope for that soft
I,
landing?
I don't think it's necessarily. You can be hopeful whenever you want to be honest with you. And I'm never going to tell someone not to be an optimist. But at the same time, yeah, I think there is still a lot of numbers and data to come about, right? Like, everything in economics has some sort of a lag to it. It's just a matter of how much. And we're seeing a resilient economy, a resilient-ish job market, um, and that's stayed the course in terms of being continuously resilient. At least not completely falling off a cliff like the Fed once was hoping it would. Uh, but at the end of the day, like we have an economy that's been fairly resilient, and CPI is getting a little bit more controlled to a place where it's not going to be breakneck or absolutely red hot. It's still hot, warm or hot to the touch, I would say, on the core side, right? But that doesn't get solved overnight necessarily.
Mhm.
So these are things that we have to continually monitor. But I think there is reason to have hope for possibly a soft landing nonetheless. The stars are sort of aligning, but a lot can happen, right? And we know this from the time of like the beginning of the Russia-Ukraine conflict and war, right? Like that was a curveball. There's other curveballs that can come out of
Sure. Hmm.
that we have no idea that are coming. So there's things that we have no control over. But let's just say for right now, things look better than most expected, especially like you mentioned, like last year. Everyone was bearish. There is silver linings here, and things are looking okay.
Yeah, it's been quite interesting to see the slow and subtle shifts. And like you said, Fed is basically locked into, it sounds like, a quarter point increase. One, because they telegraphed it, and the Fed's current policy right now is, if you telegraph it, even if you get news to the contrary, like just change it, like just make your next move about whatever the current information is. So even a great, the best CPI print in the world probably wouldn't have changed this upcoming one, because whenever the Fed changes, it seems to signal to the market in overabundance of reaction, right? They think, well, if the Fed's going to change what they already telegraphed, then maybe this is like not just big news, but like the biggest news, and kind of overreact. So it sounds like we're getting that last quarter point, or maybe not last, but at least another quarter point, increase to the rate before possibly, hopefully, another pause. It's like finishing, this raise is kind of like finishing your dinner, getting absolutely stuffed on 3/4 point and half point raises, and finishing your dinner with a nice amaro, maybe like something Sicilian, a little bitter, a little sweet, to really just cap off a great night of dining and eating and drinking. So,
There you go.
Jerome Powell, ever the gastronomist, is really just capping off a great 1 year meal of raises. Hopefully, if we continue to see this movement, do you think past this quarter point raise, we'll continue to get pauses?
That's kind of what I suspect, and that's a little bit what the market's pricing in, right? Like the market readjusted, and I think the market's been eager. It's been eager to not have another rate hike priced other than the July one. They really like any sort of optimism to take it and run with it a little bit. Is kind of what we all see a little. It's just in the day-to-day standpoint, right? Like the jobs numbers at the beginning of the month with the ADP side of things really, helped kind of solidify maybe another hikes there, and Fed speak as well to kind of contribute to that. We do have kind of the last of our Fed speakers, on Tuesday of this week, and then we really have the silent period before the decision that happens on Wednesday, the 26th next week. So we have like kind of the last ditch effort of getting some more clarification on how to interpret that CPI print. When we have those Fed speakers on Tuesday morning, around 10ish or so, and then we're kind of left to our own devices, I guess you could say, and just have to ride it out from there and see what Jerome Powell has to say after they either announce a hike or no hike, or surprise 50 bips hike. I'm just playing all situations there, but at the end of the day, like that's kind of what we have to anticipate, and we'll go from there.
Yeah, should be interesting. I'm excited to see how this plays out over the rest of the year. So, besides Fed speakers, and just kind of waiting around for next week, what are we looking at this week as far as news?
Yeah, so we'll have some like retail sales, industrial production. We'll have initial jobless claims as always. That's going to be an important one. But we also have some housing data. We have housing starts, existing home sales, all those sort of things that help kind of keep an eye on just how the home building world is going and all the good stuff. We had a very big surprise on housing starts last time around. Let's see if that pace continues or there's kind of a correction necessarily down. So we'll see kind of how that plays out. That'll I think housing starts itself, bringing more supply online in the future, and housing is something that everyone wants to see, regardless if you want rates to go up or down or who in the world you want to see more housing come online. So hopefully we can kind of see a continued pace there of like home builders able to actually execute and start more projects necessarily. So that'll be good. And really just that's kind of the main things I would say to look out for is we have Fed speak, just some other data metrics such as retail sales, housing starts, and initial jobless claims. Those are kind of the things here this week. Nothing crazy, stop at all costs, pay attention to this, but there's some data to add to, maybe a little volatility, but I don't think anything too crazy. So hopefully we'll have a calmer week where we kind of stay in this range again, and we don't have too much drama.
Nice. All right. Well, before we go, let's chat a little bit about the mortgage side of things. Last week we were lamenting, slim rate stacks when compared with pricing, and I think UWM just opened, rates in the eights, which is not necessarily great news, but it does help, and it looks like it comes with a. I'm looking at pricing now. It comes with a fair amount of premium, so it's not just this slim 10 bips to get to 7.875 and 10 more bips at 8%. The spread between 7.75 and just 8.25 is 75 whole bips. So, not a ton of premium there, but there is some. Are we seeing a higher appetite in the market and more liquidity for these higher note rates, or is this just UWM doing us a favor?
So I would say it's a limited amount of liquidity. I mean, there is, it's Fannie and Freddie that are, opening this up. Nonetheless, I think it's really actually Freddie at this point, to be honest with you. But they're opening it up, that part of the market again. We had this for a little bit of time. Remember, back in 2022. So yeah, so it's we do want to forget some of that the end of that year, but hey, we saw it before, and depending on how liquid or how used this is, how long does it stay around? Who else brings this onto their rate sheet? It's probably not going to be everyone. Just depends on what they want to do from their capital markets team, and you're just going from there. We'll kind of continue to see a little bit of premium, right? Like you said, a little bit of premium relief. I mean, for some typical loan scenarios, that actually might be a good thing, especially those non-owner occupied type loans, right?
Sure.
Where you do need extra premium where you can get it. Those are some things that are good, but yeah, I would say just still we have value in the rate stack at certain points, and especially in the Govy side, you always take a look at that rate stack. It's very important. Conventional as well. I think people are trying to be competitive. Take a look at the rate stack, all things considered. But yeah, we do have a little extra premium at the top. Great. Hopefully we can get continued market recovery, so we don't have to worry about eights generally.
Yeah, I agree. Although, yeah, I am seeing investment property 20% down, reasonable loan size, not failing points and fees. So, not.
There we go.
If you're an
guys.
investor, maybe not exactly what you want to see in the discount points column, but not failing points and fees. So
Exactly.
great. Like I said, very auspicious. So before we go, hit us with any teases you got on the investor or lender side of thing. Anything we can expect to see rolled out in the next week or two for those of our watchers who make it to the end of the Monday mortgage market update.
Yeah, so you guys probably saw we had new lender added into Arrive. There's a couple more that are coming in as well. here in the next week or so, I think, with Arrive also. So some of these lenders that just got added in, we'll be starting the sign up process with them here shortly. Most likely, we also have one with an already integrated lender that's very close to getting finished up, and then it's just a matter of getting the training done on our side and getting that rolled out to all of you guys. So
Any hints on the integrated lender? Come on.
So I don't know. I don't want to step on Arrive's toes, but obviously PennyMac just got integrated. That was announced and all that good stuff. We also saw, Newers is probably one of the big ones that we don't use within our own, Arrive. So that's one of the ones we're actually really close with, getting the rollout finished. So that's, something I think we can continue to bring pricing competition to the, integrated lenders we have, and have someone that's able to execute on loans nonetheless. So it's a big deal, and we want to continue to have you guys succeed, as well as being competitive and still able to close that competitive price, right? So that's the name of the game, especially in this purchase market.
All right. Well, you guys heard that nugget here first. Don't go telling everybody, but there are some new integrated lenders coming to Arrive, and it sounds like they may be coming to UMortgage as well. Thanks for your hard work, as always, Austin and the rest of the capital markets team. Thanks for being here this morning, Austin, and all of our viewers. We will see you again next week. Let's go get some loans.
Let's do it. Have a great week, guys.
Hey, everyone.